A delicate balance between unexpected domestic hiring surges and the sudden prospect of international peace is currently reshaping global finance. The release of the Automatic Data Processing Report provides a critical benchmark for the resilience of the United States economy. Gold prices are currently maintaining very solid and highly consistent upward gains. The Automatic Data Processing Employment Report signifies the fastest monthly hiring pace observed since January 2025. It suggests that the slow hiring equilibrium of the past year may be evolving into a much more constructive growth phase. This headline addition significantly outperformed previous baseline consensus estimates. Private sector employment in the United States increased by 109,000 jobs during the month of April. This solid private sector gain provides a very critical benchmark for the ongoing resilience of the domestic economy. Global investors are currently closely watching these latest labor market data developments. The internal mechanics of the April report reveal a labor market that remains heavily reliant on specific structural drivers. Service-providing industries contributed 94,000 of the total added jobs. This clearly underscores the ongoing shift away from a traditional goods-centric recovery within the United States economy. Within the service segment, the education and health services sector continues to act as the primary stabilizer. This particular industry added 61,000 new positions during the month. This persistence accurately reflects the highly inelastic demand for healthcare and the aging demographic profile of the domestic population today. Trade, transportation, and utilities sectors experienced a notable recovery by adding 25,000 new jobs. These specific roles often represent the logistical backbone of the national economy. This growth provides a strong counter-narrative to the recessionary fears that intensified following the meager economic growth late last year. The construction sector also showed positive momentum by generating 10,000 new employment opportunities in April. Furthermore, financial activities contributed an additional 9,000 jobs to the overall private sector total. These figures demonstrate a relatively broad-based hiring expansion across multiple essential industries in the broader domestic market. Information services and the leisure and hospitality sectors each managed to add 4,000 jobs respectively. Meanwhile, natural resources and mining industries saw a modest increase of 3,000 positions. The manufacturing sector contributed a marginal gain of 2,000 jobs during this particular reporting period for the economy. However, the professional and business services sector experienced a significant contraction by losing 8,000 jobs. This unexpected decline suggests that corporate efficiency drives and artificial intelligence integration are impacting white-collar roles. Firms are actively seeking targeted reductions in redundant positions to preserve their profit margins moving forward. Another minor loss was observed in the other services category, which shed 1,000 jobs. Despite these isolated sectoral losses, the overall employment landscape reflects a transitioning phase characterized by resilience. A highly nuanced examination of the hiring patterns by establishment size reveals a deeply bifurcated labor market environment. Small firms with fewer than 50 employees led the recent expansion by adding 65,000 jobs. Large enterprises employing 500 or more workers successfully added 42,000 new positions. Medium-sized companies experienced significant stagnation by adding a negligible total of 2,000 workers to their payrolls. Chief economist Nella Richardson has accurately identified this specific trend as visible softness in the middle. She explained that large companies possess the necessary capital resources to navigate complex supply shocks. Meanwhile, smaller firms effectively maintain the operational nimbleness required for basic survival in a very difficult business environment. Medium-sized firms appear to be disproportionately impacted by the cumulative effects of previous interest rate hikes. They often lack the massive scale of global giants or the extreme flexibility of new startups. This unequal distribution suggests that job quality might be shifting toward lower-paying precariat roles right now. Wage growth dynamics presented in the report offered another layer of complexity to the overall economic picture. Pay for workers remaining in their current positions rose by 4.4% during the month. This metric highlights a very slight deceleration compared to previous wage growth measurement periods we observed. Conversely, employees who actively changed jobs experienced a steady year-over-year pay gain of 6.6%. These wage figures suggest that domestic inflation pressures emanating from the labor market remain relatively benign. This data point provides the central bank with crucial information regarding core inflation trends today. Geographic variations in employment growth were also meticulously documented within the comprehensive April Employment Situation Report findings. The western region of the United States experienced the strongest performance by adding 46,000 jobs. The southern region followed closely behind by generating 34,000 highly essential new working positions. Employers located in the northeastern states managed to create 18,000 jobs during this specific timeframe. Meanwhile, businesses operating in the Midwestern states added 11,000 workers to their active payrolls. This regional data highlights an uneven but persistent nationwide economic expansion, despite numerous lingering macroeconomic challenges across the country. Market participants quickly digested these newly released employment figures, alongside major breaking international geopolitical developments. Reports regarding a potential breakthrough in the severe ongoing conflict between Washington and Tehran dominated the headlines. A proposed 14-point memorandum of understanding has dramatically shifted global risk sentiment across all major trading floors. This highly anticipated diplomatic agreement aims to completely dismantle the intense stagflationary pressures characterizing the global economy. The proposed interim framework is specifically designed to end hostilities immediately and establish a short negotiation period. Diplomats hope to use a 30-day window to finalize a comprehensive agreement between the nations. The direct decoupling of the complex shipping dispute from the sensitive nuclear dispute represents a key negotiating strategy. This approach allows for immediate economic relief while deferring the most technically difficult political issues. Global energy markets reacted violently to the sudden prospect of peace returning to the volatile region. Brent crude oil experienced a massive double-digit percentage decline following the rapid circulation of these diplomatic reports. Prices collapsed to approximately $98 per barrel as the extreme geopolitical risk premium quickly unwound. This dramatic downward move reflects market assessments that the severe supply shock is finally ending. The effective closure of the Strait of Hormuz had previously threatened to push the global economy into recession. Approximately 20% of the total world crude oil supply historically passes through this incredibly narrow waterway. The recent reduction in energy costs acts as a massive global tax cut for consumers. Easing energy prices will inevitably reduce the intense pressure on disposable incomes and significantly slow headline inflation rates. Consequently, bond yields rapidly accelerated their steep falls across various major international government debt trading markets. The 10-year United States Treasury yield immediately fell by several basis points during the session. German government bonds also dropped below 3% for the first time in nearly 2 full trading weeks. Investors are aggressively reconsidering the deeply hawkish repricing of central bank policy that occurred recently. The previous probability of further aggressive monetary tightening has diminished substantially across the board for major institutions. These dynamic macroeconomic developments provide a highly supportive backdrop for precious metals despite the sudden reduction in war risk. Gold prices held solid gains and continued trading near $4,700 per ounce. This remarkable resilience highlights a very significant transformation in the current role of physical gold. The yellow metal is increasingly viewed as a critical hedge against long-term sovereign debt sustainability concerns. Institutional investors are utilizing gold to protect massive portfolios against persistent systemic currency debasement trends. From a technical perspective, the precious metal is currently testing a structurally important resistance zone on the charts. Market analysts have precisely identified this crucial resistance area between $4,680 and $4,710. A decisive technical break above the 50-day exponential moving average has recently provided professional traders with a very clear short-term market buy signal. The asset must sustain this powerful rally by successfully clearing the psychological hurdle located at $4,720. The relative strength index, currently sitting near 49, clearly confirms that this ongoing rally has not yet reached the dangerous exhaustion phase typical of speculative market tops. The long-term outlook for bullion remains remarkably constructive among the largest global financial institutions operating today. Projections for the end of the year suggest a broad consensus that the metal will challenge its previous all-time high. This aggressive target currently sits at $5,608. Several major banks point to persistent central bank reserve accumulation as a primary driver of this sustained upward price momentum. An ongoing transition away from a dollar-centric global reserve system provides additional fundamental support. Global gold demand actually reached a historic record high during the first financial quarter. Total demand topped 1,230 tons, according to the latest figures from the World Gold Council. This incredible demand is increasingly driven by over-the-counter investment and massive sovereign accumulation. These massive institutional purchases provide a much higher price floor during inevitable technical market corrections. The Federal Reserve policy landscape also significantly influences the trajectory of these precious metal valuations over time. Policymakers recently maintained the federal funds rate at a steady range of 3.5% to 3.75%. This crucial rate decision occurred during a highly scrutinized April committee meeting. This particular gathering marked a historic moment because 4 officials dissented against the broader committee decision. Such a divided vote has not been recorded since October 1992. These highly unusual dissents reveal a fundamental internal disagreement over the forward guidance language provided by the American Central Bank. 3 members strongly objected to the current easing bias by suggesting the institution should remain completely neutral. A 4th dissenting member actually favored an immediate rate cut to stimulate lagging economic activity. This fractured backdrop suggests that incoming leadership will inherit a deeply divided institution moving into the crucial summer months. Analysts expect the new chairperson to rapidly introduce a range of structural reforms to the monetary system. These anticipated changes will likely target the massive balance sheet and the forward guidance communication framework. A potential pivot toward focusing on artificial intelligence productivity might help contain inflation while allowing lower funding costs. Despite the undeniably resilient labor data shown in the recent report, most market participants remain incredibly cautious. They generally do not expect the central bank to begin cutting interest rates until at least September. Policymakers clearly remain in a strict wait and see mode regarding the broader macroeconomic picture right now. Officials specifically want to see the backside of the recent energy shock before committing to any new cutting cycle. The logic for a lower interest rate path heading into the year-end is strongly supported by economic models. Current monetary policy levels are widely considered to be mildly restrictive. This restrictive stance is having a potent dampening effect on highly sensitive sectors like housing and small businesses. If the conflict concludes and inflation expectations remain properly anchored, the central bank may find additional flexibility. They could potentially enact 2 small rate cuts before the current calendar year finally concludes. While the private payroll report provided a very positive psychological boost, the definitive signal will arrive on Friday. The upcoming official employment situation report from the Bureau of Labor Statistics will offer a much clearer picture. Market participants are cautiously bracing for a potential cooling in the official employment numbers. Consensus forecasts for the highly anticipated non-farm payrolls currently sit in the 60,000 to 73,000 range. Leading economists have identified the 124,000 job level as a deeply critical threshold. Falling below this line could drastically alter the prevailing market narrative completely today. Recent benchmark revisions previously wiped out 124,000 reported jobs from last year. This alarming adjustment suggests that the essential labor market buffer is considerably thinner than analysts initially perceived. If the official report prints below this critical mark, stagflation fears will quickly multiply across markets. A significant miss would undoubtedly confirm that even the historically stalwart healthcare sector is beginning to naturally slow. Various market scenarios predict different outcomes, depending on the exact magnitude of the impending official payroll release. A strong beat exceeding 150,000 jobs would greatly strengthen the dollar. Such an unexpectedly robust labor number would simultaneously re-engage higher for longer interest rate expectations across trading desks. This specific scenario would inevitably place considerable downward technical pressure on current spot gold market pricing. Conversely, a moderate beat would likely promote overall market stability and support domestic equities going forward. A result falling within the lower consensus range would serve as stark confirmation of a cooling domestic economy. This particular outcome would generally be viewed as highly bullish for both domestic equities and government bonds. A significant miss falling below 40,000 jobs would instantly ignite deep recessionary fears everywhere. Such an extreme downside surprise would trigger immediate dollar weakness while providing a bullish catalyst for gold. The domestic unemployment rate is expected to remain stable or perhaps tick down very slightly. Currently sitting at 4.3%, this key metric remains historically low despite rising economic concerns. Data regarding job openings and quit rates showed a very slight uptick during the previous reporting month. These specific labor indicators suggest that the current market is experiencing a complex phase of internal churn. It definitely does not resemble a straightforward linear decline in total available employment opportunities right now. The recent massive market volatility observed on May 6th was certainly not strictly limited to United States assets. Government bond yields in the United Kingdom fell sharply during the same volatile trading sessions. The 10-year yield dropped more than 12 basis points to sit firmly under 5%. This drastic move was particularly notable because it directly followed a sustained period of unusual market decoupling. British yields had previously been rising even as global oil prices began to fall substantially. This earlier decoupling has been primarily attributed to a very specific local political risk premium taking hold. Markets are expressing deep concern regarding the potential for a sudden political crisis following the scheduled council elections. If the governing Labour Party suffers major unexpected losses, the current leadership could face severe challenges. Investors remain particularly wary of left-leaning replacements who might quickly abandon existing fiscal rules. Such political upheaval could potentially reignite lingering concerns over long-term debt sustainability and inflation in Britain. Meanwhile, across the English Channel, Eurozone inflation expectations are experiencing a massive peace tailwind right now. The 10-year German bond yield successfully fell below the highly psychological 3% mark today. This decline occurred because the sudden easing of the massive energy shock drastically reduced expectations for aggressive tightening. The common European currency gained substantial ground against the dollar, supported by a broader safe haven sell-off. Geopolitical fears are abating rapidly as diplomats continue working productively behind the scenes today. The catastrophic domestic economic situation in Iran is likely driving their intense urgency to secure a diplomatic deal. Following the implementation of severe blockades and subsequent financial sanctions, the Iranian rial hit unprecedented record lows. Basic everyday goods have become prohibitively expensive for the average working citizen to currently afford. Recent reports indicate that simple common commodities like sausages are now costing upwards of 1 million rials. The national minimum wage has effectively plummeted to below 90 United States dollars per calendar month. Furthermore, the Iranian labor market is currently experiencing a devastating widespread employment shock across the nation. Mass factory closures resulting directly from extreme raw material shortages have completely devastated the local manufacturing base. The sudden collapse of regional trade with the United Arab Emirates has massively exacerbated these structural issues. This essential trade corridor previously handled 80% of all Iranian currency settlements for international business. Tehran currently possesses very few viable alternatives for conducting routine global commerce or processing international payments. This total economic asphyxiation has created a binary decision point for the deeply divided Iranian political leadership. Pragmatists desperately seek a diplomatic exit, while hardliners remain incredibly wary of American intentions moving forward. The proposed peace document heavily relies on an intensive verify and trust approach to ensure mutual compliance. Washington can quickly reinstate its aggressive naval blockade if Tehran fails to meet the strict initial benchmarks. Regional mediators, including Pakistan, strongly support this highly structured verification framework, moving forward toward absolute peace. The convergence of these events marks a truly historic potential inflection point for the entire global economy. Domestic employment data strongly suggests that the labor market is successfully maintaining a very fragile but functional equilibrium. This balance provides a completely necessary buffer against a painful hard landing for the economy. The Federal Reserve must carefully navigate this complex transition while managing persistent core inflation across the economy. However, the true catalyst for the current positive market regime remains the reported progress toward Middle East peace. If finalized, the memorandum will significantly reduce supply-side inflationary pressures globally for all nations. The sudden collapse in oil prices serves as a de facto rate cut for struggling consumers everywhere. It potentially eases the massive financial burden on ordinary citizens and struggling small businesses trying to survive. For gold investors, the ongoing macroeconomic transition is subtle but exceptionally profound structurally over the long term. The asset is rapidly shedding its immediate war premium only to replace it with a sovereign risk premium. Investors are looking past the current localized conflict toward the long-term challenges of global debt stability. They are increasingly concerned about maintaining currency value in an uncertain fiscal environment right now. As the financial world moves toward the release of the official employment report, cautious optimism generally prevails. The desired direction of travel toward military de-escalation and domestic labor market stability appears relatively clear now. However, the path forward remains narrow and highly contingent on successful diplomatic implementation by all parties. The continued resilience of the American consumer during a period of structural economic change is absolutely paramount. Both the gold market and broader equity indices will continue closely monitoring these intersecting geopolitical and economic narratives. This definitively marks the beginning of a truly fascinating chapter in modern global financial history.